You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Seth Ferguson, Canadian real estate investor with a huge portfolio in United States of America. Please help me to welcome our today's guest. How are you, Seth?
I'm good. How's it going?
Thanks so much for being with us today, and I appreciate you taking the time.
Yeah, happy to be here.
Thanks a lot. I would like to start with your beginnings on multifamily and the reasoning of the switch between as a Canadian to the US market.
Yeah, so that takes me back to when my son was born. At the time, I was doing some single family investing with my partner at the time, and it was, like a lot of investors, single family home investors in hot markets, we were equity rich but cash flow poor. Yeah. So I remember this one time, the drain out to the sewer, a tree root had gone through it, so it had to be totally replaced and repaired, and that cost $8,000, and that basically wiped out like 3 years of cash flow on the property.
Yeah,
because it was just an appreciation play. There was no cash flow there, and that made financing tough. Residential financing is the burden shouldered by the borrower, the poor cash flow. It wasn't scalable. So when my son came along, and I wanted to do bigger stuff for him now because he was in my life. I knew that single family wasn't going to get me to the scale I wanted to be at. I remember sitting down and working out how many houses I would have to own to hit my real estate goal. And it was like 1,000 houses. So I don't know about you, but owning 1,000 houses is just pure insanity.
Doesn't make sense. Yeah.
It doesn't make sense. So, I needed to look for a different type of real estate asset I could own and scale. So I looked at industrial, retail, office, mobile home parks, self-storage, and multifamily. And multifamily made a whole lot of sense to me. People always need a place to live. We saw that over the past couple of years. People will close up their offices. People will, relocate their businesses, go virtual, but people still need a place to call home. And multifamily was rock solid. And you look at the past, 3 recessions, and multifamily outperformed all the other real estate asset classes. So, when I was looking for a place to transition to, a real estate asset to transition to, multifamily ticked a whole lot of boxes and made a whole lot of sense. And that's when I made the switch over.
Makes sense. So going back now to the main focus, to be honest, is the US market right now, especially after the inflation. The cap rate is really compressed in a lot of markets. Some of the markets has already appreciated, doubled within the last 12 years. Coming to this question, when you're doing a market analysis, you mentioned that you're focusing on Texas and Florida. One of the things for me is what is going to happen when the market crash, especially that right now you're not looking anymore to cap rate, you're looking for price per door. So you have 2 different packages here, which is, for example, in Memphis, you're looking for steady market only with cash flow within and versus Texas with appreciation, less cap rate, and so on. So how you make the bargain and choose which market you prefer?
Well, we look for very specific market drivers. Right now, what's happening in the southeastern U.S., I think there's a lot of runway left there. We have people fleeing both coasts, not only to escape taxation, but all the jobs are moving to the southeastern U.S. You look at, you name it, like even Joe Rogan, the podcast king, left and is going there. So a lot of business, a lot of money is moving there. The jobs are moving there, and we've seen it for hundreds of years. People will follow jobs, and right now GDP growth is very strong. And we've seen, population growth quite strong too. You look in the southeastern U.S., you have a wide variety of employment and industry sectors that make these markets very stable. And I think policy plays a fact into that as well. You look at taxation policy, that's a big plus, very pro-business. You look at California, you can't tax a state into success. You can't fix a problem through taxation, but that's what's going on in California. So for those reasons and many more, that's why we're focusing on Texas and Florida. And like I said before, I think we've got a lot of runway left in terms of growth. You look at the demographic shifts occurring right now in the U.S. population. That's going to keep happening. And then you add in immigration numbers to that. The numbers look very good if you're an apartment building owner.
That's perfect. But going to this point about the population growth, this is a basic shift because of the COVID-19 and everyone is immigrant from New York and Washington and big states, or this is going to be like permanent? Because you mentioned that there's an actual job growth there on this market. So this is basically an actual, like, for example, Cincinnati, Ohio, the market is appreciated. There's a job growth, but not too much. The cap rate is perfect, but what is going to happen after 2-3 years when everything is going back to normal and everyone want to get back to New York, for example?
Yeah, well, you look at the demographic shift, like that was happening long before COVID even existed. We've been watching this trend for the past 8 years, let's say, and every year it's fascinating. Some major brokerages and some analytics companies, they'll publish maps, and it's interesting to see. You'll see positive population growth, negative population growth, and you could segment that by age group. And young people for, let's say, the past decade have been leaving the East and West Coast because like the affordability isn't there, the jobs aren't there, they're being taxed through the roof. So they've been going to where the jobs and the taxation is better. It didn't really, COVID presented some challenges, but the shift is not happening because of COVID. That was in place well before, and it's going to continue for well after. For Canadian listeners, right? It's kind of like right now, if you're living right downtown Toronto, where's affordability, right? If you're a young person starting out, you're not going to afford living right downtown Toronto. You're going to look somewhere else. And right now, there's a lot of interest in Calgary for young people to go to. It's the same thing happening. Except in the U.S., in especially Texas, like there's no rent control. So from a policy perspective, it's a lot better.
100%. So this is basically one of the part of U.S. is it's more landlord friendly versus like Ontario is more like a tenant friendly. So there's no rent control. You can enhance, add value. You can have your own strategy basically, and I think this is one of the reasons for you to immigrate to basically to the US market.
I'm a big proponent of the value add investing strategy, and just in case somebody's not familiar what value add is, it's basically you're acquiring an underperforming asset and you're doing improvements to it, whether it's through physical renovation, physically changing the property, or through operational improvements. So whether that's branding, management, expense optimization, anything under that umbrella. And basically we're looking at bringing that asset to the market standard. So if we are acquiring a property that's under rented and mismanaged, we'll go in, improve that property and bring it up to where the market is today. And people talk about a lot about cap rates right now, but it's, as long as you're going in and you're improving the asset and you're doing so in a proven way, like you have your rent comparables, you have your sale comparables, you know exactly what the market's going to bear. If you know that you can bring your average rent per unit from $1,500 to $1,800 a month, and you have the support of the market, you are manufacturing your own value in that case. To me, that is a much more sustainable and much more controllable way of investing rather than purchasing a building using a core or core plus strategy where you're just banking on appreciation to move your asset up. And when you factor in rent control, that puts a big screwdriver in it because you can't recoup, you can't earn a return that you would be expecting to earn by risking your capital in the marketplace. So I think it's a totally backwards policy, and I think it ends up hurting the tenant, as multiple studies have shown that rent control cities or rent control provinces, rents actually become less affordable than in a non-rent controlled environment. So for those reasons, we're definitely looking south of the border. Because we want to be able to control, the money we put in, what we can do to the asset, and with the end benefit of being for the tenant. If we're able to improve an asset and provide a better living experience, the tenant benefits, we benefit, our investors benefit, everybody wins. And I think it's unfortunate when you have a couple bad apples in an apartment community, and the legislation doesn't allow you to remove them. What about the 99% of all the good tenants there who just want a safe place to live, but then you have to go through hoops and hoops just to remove a bad actor who shouldn't be there in the first place? So that's a bit of a rant. I could go on for hours about rent control, but I'll tone.
It's not existing. I think in the South states, all of this is rent control states, especially Texas and I think Florida. Oklahoma, all of this state is rent control free. So
and then you look at California and compare it to Ontario. Even California's rent control isn't as onerous as Ontario's. So everybody's in the U.S. is California's rent control, but then you compare it to Ontario, it doesn't even match up. So for it's unfortunate that we do have rent control. I think getting rid of it would bring about a lot of improvement and change, and also provide more affordable housing, because then you have more incentive to have purpose-built rental buildings rather than just a developer now just doing condos, because that's where they make the money.
100%.
So there's a lot of factors that go into that, but I think if we had a policy shift, then we'd see some good changes.
100%. So my next question again about the criteria now is a compressed cap rate because of the new interest rate. Right now, you can see like in Atlanta, for example, the rate is going to 3.5, the cap rate for the purchase price. So this is coming back to the same numbers, I think, in Hamilton here and Guelph, London, even Ontario. I'm not going to say on Toronto because Toronto is like 2.2 right now. So we're not going to talk about the major cities. But what is the upside now for you, especially with a compressed cap rate when you're comparing apple to apple between Canada and US, especially that the cap rate even is not there?
Yeah, well, with the value add type of strategy, a compressed cap rate actually works in your favor. Because every dollar of NOI your property is producing, that's going to give you a much higher valuation when you do raise those rents or when you do bring in those improvements. But I think the key right now is in our underwriting. If we're looking at a 5-year exit, what are we assuming the exit market conditions at divestment to be? I think a lot of beginner investors assume that the market's going to be very similar to the way it is now, which is a mistake. You should always be factoring in a softer market, so higher cap rates and like a softer type of atmosphere for selling. And as long as you're writing that in, including that into your underwriting, you should be okay. You just need to find ways to manufacture that value and boost up that NOI. And that's why I said, we don't really look necessarily at cap rates. We look at, where's the value add component and how can we make that work to our advantage? A low cap rate, like I said, if we're able to bring in that value, whichever way we choose to bring in for that specific property, compressed cap rates, it pays us more to do so. But in the event that, cap rates soften up, we need to be able to exit and hit our numbers. And that's where, doing your due diligence and underwriting it in a more conservative fashion definitely comes in handy.
I think this is a really good lesson about this. When you're doing the underwriting for the pro forma on the next 5-6 years based on your commitment with your investors, you have to have more conservative approach, especially for the interest rate, because you don't know what's going to happen. So for this example, I think if you're right now the market is soft, we're talking about 4.5%, I think, on the commercial spaces. You have to assume is going to be higher on the next 3, 4, 5 years on your exit strategy. I think this is what you're referring to.
Well, for sure. And it's not even, a lot of people too include a refinance into their underwriting, and that's going to artificially boost your numbers. What if that refinance doesn't happen? Or once rates have increased, now that, you have to put all of those factors into your underwriting spreadsheet. So you can come out with, we generally work on, 3 to 5 different scenarios for the same property, just assuming different things in the market, and testing different situations. And, once if this happens, what if we hit a recession in year 4? How does this affect our numbers? You always look to see how the market performed during the last recessions to give you a bit of a hint. All this stuff comes into play. It's not just a matter of looking at a property, typing in a random number on a spreadsheet and saying, oh, okay, well, this is my assumption, because you're just pulling it out of the air. You actually have to go and find that the best data. Obviously, nobody has a crystal ball, but with real estate, it's a cyclical type of business, a cyclical type of asset. So the more we can look to the past, the better it helps us prepare for the future.
I think one of the benefits in the US market is the availability of the information. You can find a lot of databases, like you can find CoStar, you can find Zillow, IRR, a lot of resources you can base your analysis on. One of them is the comparable prices, and one of them that you mentioned on the early discussions, that when you're doing the comparable prices for the rent, you have to have a basic and do your due diligence based on actual database, and which is not, I'm not going to say it's not quite here in Canada. We don't have this kind of massive information online, I think.
Yeah, but there's still, Texas is a non-disclosure state, right? So you will never know, the seller, true, right? You will never know what the asset traded for. So there's pros and cons.
Yeah.
But I think it all comes down to, you have to know your market. And generally speaking, even in a non-disclosure state, you can pretty much know what an asset traded for, just by having a feel for what the market's doing.
Yeah.
But yeah, it all comes down to knowing your market, knowing your comps. What are the comparable properties? What do they offer? What type of what amenities do they have? What's their pricing strategy? Where has that asset gone in terms of the past 10 years, and what have they done with it? What's been successful? What did they test? What didn't work? And that's where having a great asset manager comes in, a property manager who knows their stuff. They're worth their weight in gold, because their hands are in the market on a daily basis. So they can definitely help you a lot in terms of where the market's going, picking up on shifts, with vacancy or tenant expectations, all that sort of stuff.
I think what you said is interesting, because I see that your management style is based on your core team, basically, because all of your strategy is based on a long distance management. So can you tell us about how you created your core team? How long you managed to have this core team by joint ventures? Because one of the major team members is going to be your property managers, as you mentioned. So how you're an investor in Milton, and you're controlling your assets in Texas, 6 hours away by flight. So how was your journey with building your team in the US?
Yeah, well, real estate is a business of partnerships. That's what it is. You're not going to take down a 200-unit apartment building on your own. It's very rare. And each person on your team is going to bring in something something different. You know, for instance, if you're looking at taking down any sort of asset, you're going to need on your team somebody who can bring in the capital, somebody to manage it. If it's a heavy construction type of project, somebody with construction experience who can run it. You'll probably need a KP to sign on the debt and bring the balance sheet. All these people come into play for one deal. And that's, I think, one of the first questions he asked me was, going from single family to multifamily. With single family, you don't have that team approach to doing a deal. It's generally, you'll do a joint venture partnership with one other person, potentially maybe have 3 people involved, but you won't be able to assemble a core team who can then go out and efficiently and effectively take down a large apartment building. It's not going to happen. Yeah. In your favor. Yeah. And for instance, for underwriting, I can talk intelligently about underwriting, but I suck at spreadsheets. Like that's not my forte. Yeah, okay. So by bringing in people who are, competent underwriters where that's their strength, the investors win because they're getting a specialized team. I don't specialize in underwriting. Like that's not my strength. But I can raise capital. I can speak intelligently to investors. I can bring in interest to the project, but I'm not going to sit there for 6 hours a day and just punching numbers. Single family home investing, you're probably wearing like 6 different hats. Multifamily, you can really specialize and bring in true experts for each component.
100%. You open another subject, which is raising capital. What was the challenges for you, especially when you're bringing money from Canada, especially from Canadian investor to the US? It's a little bit tricky because it's combined with security lawyers. You have to comply with the US 506B and C, and then comply again with the Security Commission in Ontario, convince or have this kind of talk with your Canadian investor. How was this process for you? I think it's not an easy process.
Well, you know what? Like, it's not. I think where a lot of Canadians go wrong is they don't seek out expert advice in the first place. Yeah. Like I've got a webinar running. I did it with a cross-border tax specialist, Lori Keatley, and every time we've run that webinar, there's always somebody on the call who's done it all wrong because they just went online onto Google and typed in investing in the United States, and they set up their LLC, and they do everything right for an American, but it's all wrong for a Canadian. So number one, you have to talk with the right people who actually know what they're doing, because that can save you from double taxation, all that stuff. Like, nobody wants to pay more tax than they have to. And it all comes down to structuring, right? Like, there's the structuring component to make sure you're tax efficient. And then also there's the compliance component to make sure you're raising the capital in a legal way. Okay. And like you mentioned, if you're raising capital for a deal in the US and bringing in Canadian investors, you have to stay compliant on the US side, but you also have to stay compliant. In Canada, you've got everything's managed provincially. In the US, you've got your federal, and then you've got your state laws there. But if you're working in the exempt market, generally speaking, like, the rules are very similar no matter where you go. Yeah. So if you're working only with the accredited investors, like, the criteria you have to meet or they have to meet remains generally the same. It's just, making sure you're dotting your I's and crossing your T's, because, especially with structuring, like, if you set something up the wrong way, your investors are going to be paying way more tax, and they're not going to be very happy with you. So, and it's your job to be the expert to make sure that everybody's able to deploy their money in a very cost-effective way.
I think this is one of the things that make you successful, is to create an investor-friendly deal. And one of them, especially if you're bringing people from Canada to US, is to how to emphasize and elaborate on the process of transfer the capital from your province, on the Canadian province, to the US state, and so on. I think that my next question will be if you can tell us about your largest deal so far.
Oh yeah, the biggest one, 278 units. That's in Orlando, and it's the Class B value add type of deal. Like the bulk of the value add's being done already. So right now it's just riding out for the next probably year before we exit there. But it's like it's on a lake. So it's like a resort style thing. You can go out and paddle boat. You can you've got a little beach there. It's pretty cool.
So it's in Orlando, so it's Florida, and
yeah, and it's literally like a resort. And one of the cool things is one of my investors. He actually he grew up in one of the units in that building when he was younger.
Okay.
His parents like rented there, and then now he's actually invested and he's a part owner of this apartment building. So it's kind of cool to be a full circle type of thing.
100%. So what was the purchase price? Can you disclose this or?
Oh yeah. So like
it's closed already, correct?
Yeah.
It's closed.
Yeah. So you're like a $30 million purchase.
Okay.
So it was definitely a larger one. And like I'm one person in the team that did the deal. Like it's not me all by myself doing everything. It takes people, right? But yeah, so that was really cool. It was kind of neat seeing kind of the property transform. Doing a lot of exterior work, changing those color scheme, interior renovations, and especially during COVID. There was like a 3-month kind of speed bump in terms of like rents dropping and some vacancy, but then things rented up pretty quick, and then we've seen some explosive growth after that. So I think if you look at COVID, 3 months of kind of unsteadiness is pretty good, considering how everything else kind of happened in the world with small business and everything. I would take 3 months of rockiness over everything else. So very, very happy to be in the multifamily space, with things going wrong.
Yeah, this is really upside of this business. It's a I heard it from one of the investors before. It's Armageddon proof business plan. You're trying to be on a position when the wave hit you, you're going to have an actual protection to your assets and your investments. So about this building, what was the upside about this building, like from management perspective? Like where do you find like there's an actual upside you can enhance and bring the net operation income in a higher level?
Yeah, so this was the 70s vintage building. And like the interiors were a little bit dated. Like they weren't like super old, but they didn't have the brand new cabinetry. They didn't have the granite countertops. So our business plan for the interiors was to go in, do your cabinet doors, your countertops, have a couple variations on that with the backsplash, some new appliances, that sort of stuff. And with that, we were able to achieve a rent premium because like the rest of the rental comps they were superior. So we were able to elevate the property in that respect. The other side, on the operational side, like there was a rebranding that happened at the property, more physical improvements in terms of exterior look. So just updating the look and feel of the property, making it feel a whole lot better when you're on site, and some additional income streams. So adding premium parking, some additional storage type of facilities there to bring in some other revenue streams, renting private yards that you can do. When you're acquiring an asset, you're not just focusing just on rent. Like there's a whole bunch of other income streams that you can bring in as well.
Yes.
That don't have to be limited to just your rent premium that you're aiming for. So you can always look at Wi-Fi could be an add-on, traffic service, premium parking. Like just be creative and see what other assets in the area are doing, and maybe you can bring that into your asset and get some extra money.
I think one of our what we did before in one of our building was the fiber. To be honest, we increased the premium only with minor touch, without even touching the unit, which is simply is the Wi-Fi. and as a fiber. So yeah, 100% agree. On this, just for insight on the new market's values and current status, what was purchase cap rate and what was on your, because you enhance based on this, you enhance the net operation income. So what was your expectation for the new cap rate after bringing the property to the current market value?
Yeah, so in terms of our underwriting, like we're always very conservative in terms of like where we're aiming to bring the asset. Like I said before, when we're looking at our exit, like we're banking on the market to be softer than it was when we acquired it. So going back, if I can remember correctly, I think we were at a 4.5 cap when we acquired it. I think
that's good.
Yeah, I think it was 4.5. And actually, with this one too, our occupancy actually went up before closing, which we were
again good.
Yeah. So we were, occupancy was like 97%, something like that, if I remember.
Pretty high.
Yeah, and so cap rate would have been 4.5, I think. Maybe 4.8, something like that at the time, and obviously now like things are so compressed, so like looking at hitting the numbers and stuff at exit maybe another year or so, and that would bring us to the end of the project.
100%. So one of the things you mentioned is for the Canadian to US is not to do is creating an LLC. And you mentioned also this, what the first thing you have to do is to consult your lawyer and your accountant for the cross-border. So how heavily you're dealing with Canadian investor right now? You're more focused on Canadian investors or US investors?
Yeah, right now it's about 50-50. So, half my investor database is Canadian, the other half is in the US. A lot has to do with, like the YouTube channel I run, like all the different assets we have, like we attract people on both sides of the border. But yeah, like especially with the Canadians, structuring is so important. And, there's a couple different ways you can do it. It's just making sure it fits best for you. There's withholding tax that almost nobody knows about. So, what are some ways that you can avoid having, the withholding tax applied? That's something you have to consider. And also, like, how are you going to structure yourself on the Canadian side of the border? Are you planning on repatriating the capital? All these things kind of come into play. And, I'm not an accountant, so I can't give personalized accounting advice, but definitely have the right people to direct people to, just to make sure like they're structuring, because it's not just, okay, I'm going to invest in this one deal. It's like, are you planning on investing for the next 10 years in the US? How many deals a year are you planning on doing? Well, if so, maybe you're going to be setting up like a C Corp, and then, you have your EIN number. So that way you avoid the withholding tax, because then the LLC or the LP, whichever how it's done, it's going to pay your C Corp. And then that way it's an American entity that you don't have to worry about withholding tax. Like all this stuff kind of comes into play.
100%. My last, it can be fun question, which is how you describe your superpower or strengths?
Oh boy. I would say my superpower is coming up with big, crazy ideas and actually making it happen. So, I think, we just had the multifamily conference like 3 weeks ago, and that was a big, crazy idea. And everybody said I was crazy for doing it. And, the team made it happen. So, we've got some even crazier ideas in the works right now. And like you just have to dream bigger and think bigger. Because I think that's one thing with real estate investing too. If you just limit yourself to thinking about small deals, the decisions you make, the people you will bring on your team, they'll be like, you're confining yourself to the small thinkers. If you think bigger with where you're going to be able to bring on different people on your team that are going to be able to elevate you. The decision-making process will be different. So for me, I think like having those big ideas forces me to think on a bigger scale. And yeah, like the team we put together because of that is just rock solid. So
I remember you mentioned on the conference, you were telling someone about you're going to bring Kevin O'Leary, and he laughed, and you did it in 1 year, I think.
oh yeah, that was my fiance. We were sitting on the couch watching
Yeah.
Shark Tank, and I turned to her and I said, "You know what? I'm going to have Kevin O'Leary speak at my conference that I was thinking of doing." And she just kind of smiled and said, "Okay, whatever." and like a couple of days later, I had Kevin booked. So you know, we can't. I can't talk about the speakers we have lined up for next year yet.
Yeah.
But I've been on the phone with some pretty cool people the past couple of weeks. So
it was really successful this year, to be honest. Everyone was enjoying about the event. I think my last question will be, what was the last book grabbed your attention on real estate or business in general?
The one book I read over and over and over again is by Russell Brunson. It's Expert Secrets. I think that's a great book in terms of building out frameworks, communicating your ideas in a very like packageable way. Expert Secrets for sure. It's not a real estate book. It's more like a business kind of book. But yeah, it's excellent.
The final one will be how people can reach you and follow your success.
Yeah, for sure. So the best way, if you're interested in multifamily investing, check out my YouTube channel, youtube.com/Seth Ferguson. And we post a weekly YouTube video specific to multifamily every single week. So we've got hundreds and hundreds of videos already.
Yeah. Thanks a lot for being with us today. And we're really happy to bring you again to the show. Thanks a lot.
Yeah, no, I enjoyed this. Thanks for having me.
Thanks a lot.